in Syria have been a major geopolitical concern. What are your views on the impact on oil prices? Should investors be prepared for bigger risks?
I have a hard time believing that the Syria question, at least in its current form, is really going to be a major and prolonged risk for global markets. We should keep in mind, of course, that Syria is not a major oil producer, and in that sense, what's happening in Syria is arguably not nearly as serious as Libya was, not more than just about a year ago. Equally, although I think markets are rightfully on edge given the possibility of some sort of U.S. or joint NATO military intervention, the fact is that the U.S. does not have the stomach for a prolonged commitment, and certainly not on the ground in Syria. And therefore, when we think about the broader risks of this becoming a deeper and prolonged conflict or a major fiscal drag on the U.S. budget, that to me looks very unlikely. So given that Syria is not, in the end, really a supply issue for oil, nor is it likely to be a major commitment of U.S. Resources, I don't believe necessarily that this is going to be a risk that stays with us for a very long time.
About 71% of Chinese companies have already reported earnings. How is it shaping up so far? And does it change your strategies for China?
Well, this has been a substantially improved earnings season for China. First, in terms of performance relative to expectations, we see that in aggregate, the Chinese results are coming in about 10% ahead of the analyst consensus, which in part, I think, reflects the fact that consensus itself, expectations, had been beaten down pretty substantially during the course of the first half of the year. But it's not just a beat relative to expectations. The actual performance in terms of year-over-year earnings growth for Chinese companies is coming in at about 16% overall. And that's, again, substantially better than the second half results from 2012, when those same companies that have reported so far produced about 10% year-over-year earnings growth. So we're getting stronger year-over-year growth, and we're getting a substantial beat relative to the pre-announcement expectations. And that is one of the reasons why Chinese equities are continuing to perform in relative terms very strongly, particularly in a region where, as we've seen recently, substantial concerns are being discounted into particular markets, mostly in Southeast Asia. And China is not only having a great results season, but doesn't actually suffer some of those same external imbalance problems or currency volatility problems that we're seeing down in ASEAN or India, for example.
Where would you invest then? In terms of Chinese shares, are you switching to cyclicals or staying with defensives?
Well, one thing that's very interesting about the market action of the past couple of weeks is that even though many Asian markets, of course, are down, and in some cases considerably down, as in Indonesia, that by sector, the best performing sectors in Asia over the past fortnight have been cyclical sectors, while the worst performers, even during this period of uncertainty and volatility, have actually been the classically defensive sectors, for example, like utilities, consumer staples, telcos, and healthcare. So what we see here, I think, is evidence that even as markets have been a bit more concerned about, for example, the capital flow implications of higher treasury yields, they're still continuing to discount a more growthy outlook for the global economy in the second half of 2013 and, of course, looking into early 2014. And so with that, as we remain positive on Chinese stocks, we absolutely believe that investors should be looking at the more growth-sensitive plays. That includes some names in the export sector in China, whether that be through ports, for example, or paper and packaging, or otherwise in some of the domestic consumption names or higher quality investment-related names in China as well. This is not a time to be defensive.